I'm Brian Briscoe, host of the Diary of an Apartment Investor podcast. And this podcast is different than everything else out there. I bring together a new and an experienced investor on each episode, and I let the aspiring investor ask the questions that they need answered. So if you're an aspiring investor yourself, you probably will have the exact same questions. Now, before we get to this episode, make sure you hit the subscribe button below and that little bell to make sure you get notified every time we post a new episode. And now, enjoy the show. Stefan, we got Seth on the line. What do you want to ask him?
What are some of the things you're doing differently now in terms of underwriting?
As far as underwriting is concerned, so we always talk about what's the most important thing, the sponsor, the market of the deal. Typically, we're going to say it's the sponsor, right? But that's a little bit different than what's the biggest risk to the deal. The biggest risk to the deal is the debt. And that's the part that's a little bit uncertain nowadays, and you need to be careful with. So when you go to your underwriting and you're planning on refinancing in year 2 or 3 or even 5, or you're going to sell, you've got to make sure that you factor in the possibility that those interest rates might be much, much higher than they are today.
Welcome to the Diary of an Apartment Investor podcast. I'm your host, Brian Briscoe. Very excited for today's show. It's another one of our Ask the Expert episodes. We've got 2 great people on the line with us today. We got Seth Bradley and Stefan Tsvetkov. So, Stefan, did I say that right?
Yeah, that was perfect, actually, Brian.
Wow, nailed it. First try, like Lego Batman says. But excuse me, what you didn't hear is me practicing it like 18 times before we hit the record button. But we'll say first try. So that said, guys, welcome to the show.
Thanks, man. Appreciate you having us on.
Absolutely. And Seth, yep. Seth, first we'll talk with you. Tradition on the show is to talk with our experienced investor first, and that's you. So let's get rolling. Tell us a little bit about yourself, your background, and kind of walk us into how you got into multifamily.
Yeah, sure, man. Well, I'll take it back pretty far, but I'll try to get through it pretty quick, man. I grew up with a blue collar background. My mom's a retired grade school teacher. My dad's a retired coal miner. So I kind of grew up with that. I call it a blue collar mindset, where it's just trading time for money, right? And to me, growing up, I just tried to figure out what's the best job I could get. And I didn't stick with blue collar, went with white collar. I ended up going to med school because I figured being a doctor was the best job that I could possibly get. Went to med school for a year, hated it, started my second year, went for a few weeks, ended up dropping out because I knew it wasn't for me. Ended up getting my MBA, and then started thinking about, well, what's the next best, still in that same mindset, what's the next best job that I can get? And to me, that was to become an attorney. So I went to law school, jumped through all those hoops, did really well there, got a big law firm job, kind of got down that pathway a little bit further, where it's like, okay, let's build 1 billion hours and try to bring in clients and, have 1 billion bosses and maybe one day I'll make partner. But along the way, I started kind of figuring out that wasn't for me either. I was just there was just something kind of burning inside that I had no idea what it was. It was really that entrepreneurial mindset, that entrepreneurial spirit. So I started investing in real estate. Actually, as soon as I got my first big law firm job, invested in a duplex. House hacked into that, started buying fix and flips and single family rentals, and kind of worked my way up to smaller multifamily into larger stuff, started investing passively into syndications and then onto the active side. So that's kind of how I went from, rural West Virginia with a blue collar mindset all the way up to big time apartment syndications.
Yeah. I had a blue collar mindset as well. When I first learned the difference between blue collar and white collar jobs, I knew my dad was a blue collar worker because he always wore a blue collared shirt to work, but he was a mailman, and mailmen that's part of their uniform. But, at least from that aspect, we both come from that blue collar home. But so walk us through that first investment property, that first, you said house hack duplex. What was going through your mind when you made that decision? You had presumably a pretty decent job at the time, but why house hack into a duplex?
Yeah, I just always had it in the back of my mind that real estate was a great investment. I mean, I remember even being an undergrad trying to convince my dad, like, hey, we should buy like these townhouses here and rent them out. And I had no idea what I was doing at the time. And obviously he didn't give me the money to do it.
Yep.
But it was always in my mind. So as soon as I had any money at all, that was the first thing I thought about doing. And at the time I was, kind of doing the thing that a lot of people do, is listen to Bigger Pockets and all of that, listen to the Bigger Pockets podcast, learn about real estate investing, and talk my wife into, instead of buying a nice single family house with, the white picket fence, we're like, hey, let's get a duplex so that we can live in one half, rent out the other. And she was good with it. So that started the investing journey. Obviously having a partner that's on board with you to live through those sorts of things and make wise investments at the beginning is a good thing.
Yeah, I actually proposed the idea of buying a duplex to my wife, and she completely shot it down. Now, the flip side is we had 4 kids at the time, and finding a duplex that has one side big enough for 4 kids, maybe I wasn't the smartest to suggest that, but
that makes a difference for sure.
It does. It absolutely did. And when she protested, it was just like, okay, yeah, you're right. There's probably not a duplex anywhere big enough for our family, but good that you guys got in on that one. Now you're in San Diego now. Was that duplex in San Diego, or was that somewhere else?
No, that was somewhere else. That was back in West Virginia.
Okay.
Yep. Still own the duplex, still a great rental. Started buying, single family duplex, 1 to 4 units, kind of all over the place, Cleveland, West Virginia, North Carolina, even in California now. Before I started, in my legal practice, I worked in real estate, closing these $100 million plus deals for other people. But I was still stuck in that mindset. To me, even though I was helping them close and I was giving them advice, I still wasn't comfortable with the fact, or even, I didn't even realize the fact that I could do those deals myself. Even though I was right up against them every single day. So eventually I kind of had that aha moment and realized, hey, I can do this too. And started kind of, doing the networking, asking people how to get involved, and started investing passively first. Invested passively in a number of deals because that's what I was advised to do, and it was good advice. It's a great way to get your feet wet and to figure out, how to invest and to see those types of investments from a passive investor perspective before jumping into the active side.
Love it. So going back to kind of the trigger, and I really like talking about the inflection points, little triggers. You say that for a while, you were just transactional. You were doing the transactions, and eventually you realized you had that light bulb moment. Was there something specific you think that triggered that light bulb moment, or what made you make that transition?
I don't know if it was just one event. It was more of a series of events where the clients would come in, we'd talk about the deal. And the more that I interacted with these clients, the more I just realized that they were just regular people. They're just guys like you and me. They're not, Donald Trump or somebody out there sitting in an ivory tower. They're just regular guys that are taking down these massive deals. Right. And I needed to, and at that point, I figured out, or along the way, I figured out, hey, I can do this. I just need to get the right network and figure out how to do it.
All right. So basically what you're saying is the more you were around these people, the more you realize that doesn't take anybody special. I mean, you have to work hard like any other business, but you don't have to show up with, the silver, you don't have to be born with that silver spoon in your mouth. So
exactly.
All right. Got it. All right. So let's talk a little bit right now about, motivation, what I call the big burning why. Why do you do what you do?
Yeah. My big why is freedom. And I know it sounds a little bit generic, but I can dive a little bit deeper. I think the first step is really freedom of money, right? You need to figure out a way to not stop trading your time for money. So that creates freedom. And that's my big why, is to create freedom of your time, freedom of relationships, freedom of location, just so you can do what you want, when you want, where you want, and who you want to do it with. So, just the word freedom really encompasses, a number of things. I mean, family, friends, experiences, and mainly just living a fulfilled, happy life that you can be happy with.
Yeah. And we've done 260 or so episodes, and that theme keeps on recurring. I think that's a motivation for most people, is to be able to control your life. Essentially, you not have to, trade time for money, not having to keep on, going back and punching that time card. Does anybody punch time cards anymore? I don't think that's even a thing anymore, but,
I mean, attorneys are pretty damn close, man. I mean, you got to bill every 6 minutes. So
yeah, I often wonder, and I'm looking at a Word document on my screen. They have like the old floppy disk line. My kids have never seen a floppy. And I think some of the things we say, like punch your time card, there used to be a little, lever you'd pull to punch it. And so anyway, the kind of funny how I think language evolves, but I digress. We need to get back to the topic, but yeah, why Microsoft still uses that little floppy disk for their save button, I don't know. But anyway, let's talk a little bit about some of the multifamily projects you've been involved with. If you could, pick your favorite, whichever one you want to talk about, give us an idea of, the scope and your involvement in it.
Yeah, I mean, I'll talk about one we have going on right now. It's 506C, so we can talk about it. It's
all day long.
Bonovia at Withers Farms. It's actually a 55 plus senior housing apartment complex, 190 units. It's in a suburb outside of Kansas City, and this is a little bit new for me because it's ground up development. Now, not new to me as far as an attorney. I've done tons of deals like that. But being on the GP side of things, the development thing is pretty new. But it is, with the way that cap rates are being compressed and the competition out there for, your typical value add multifamily is just getting harder and harder and harder to find. I'm seeing more opportunities in development and even other types of spaces. So this was an excellent opportunity. It's actually a JV with the developer themselves, and we're coming in with a big chunk of capital and resources.
Nice. So a couple of questions there. Why 55 plus? What's led you towards that?
Really, it was sourced from the developer. That's what they focus on. They've done this type of thing many times before, and that's what they focus on. And this suburb in Kansas City actually doesn't even have any of that type of housing, so it's in demand. So it's more of a supply and demand type of thing that's bringing that about.
Okay. Now I just did some quick mental math. It helps that I'm 45 and I can just add 10. So that's like 60s. People who were born in 65 or earlier, 66 or earlier, are in that 55 plus group. And I was just thinking, that's like the tail end of the baby boomers right there. So we got a lot of baby boomers who are in that age group right there. And I know a lot of people are downsizing. So
that's right. And these seniors, but it's 55, you're not that old. It's, there's a clubhouse, there's a fitness center, there's an outdoor pool, there's, patios and dog parks and everything, just like you'd see in, a brand new Class A multifamily.
Yeah. And I mean, bringing it closer to home, literally the house that I'm sitting in right now, we purchased 2 months ago from a couple that was, 60, I think they were right around late 50s, early 60s, empty nesters. And, they had 6 kids, or they still have 6 kids, but they didn't need a 5-bedroom house anymore. Me with 5 kids, I still need a 5-bedroom house, but so that's exactly what they're doing. And I think the 55 plus move is a smart one in a lot of ways, just because of the demographics. You have the baby boomers, the largest generation at its time and they're all looking, not all of them, but a lot of those people are looking to downsize, looking for something that suits them perfectly.
Yeah, I mean, I can just think of my parents. They're a little bit older. They're in their 70s, but we have a 200-acre farm in the middle of nowhere. They can't keep up with that. They would love to live in a facility like this where you've got everything there. You've got folks your same age you can socialize with, and you don't have to worry about all the upkeep anymore.
Yeah, a lot of pluses in there. And then the other part of this that's you said was new to you was development. Talk us through a little more detail why development and what the actual benefits are there.
Yeah, I mean, at least from the investor standpoint, the ground up development should have better returns. I mean, because theoretically there's more risk, right? Theoretically there's more risk. You don't have the existing building there, you're building from scratch, and you can come in different parts of the development process to de-risk it. For instance, this one is already entitled. They've already laid the foundations before we joint ventured with them. So a lot of that stuff is out of the way.
Yep.
It's in a Midwest market, so it's not in California or New York where it's really hard to get entitlement, and you can be delayed for 3 to 5 to 10 years, who knows? So there's ways to de-risk it. So, that's one difference. You should get better returns. You end up with a better building, a better community by the end of the day. You shouldn't have, these massive maintenance bills by the end of the day. So there's a lot of advantages to go along with maybe a little bit more risk.
Yeah. Yeah. And something that I realized not too long ago, I think development is the ultimate value add. A lot of people talk about value add properties, but taking a bare piece of land and putting something on it, I mean, that's better than any C-class value add I've ever seen, as far as how much value you're actually adding. So, and some things that I've noticed in a lot of areas with the pricing right now, the cost basis is lower when you come in and develop, which sounds crazy. I know like 3 years ago when I started investing, and we're all the properties that I'm GP in are Southeast, but when we started investing, the new build cost was almost twice as much as buying existing C-class. And I think the tables have turned now to where in some areas it's cheaper to build than buy. So
yeah. So I said I was new to development. This is actually the second one. We closed on another one earlier in the year, but it was a little bit different. It was a build to rent community, and that was in Lafayette, Louisiana. And just to your point, including the land, the entitlement costs, and the build, we ended up about $130K a unit for a 3-bedroom, 2-bath house, 1,300 square foot house.
And what's a comparable house go for in that area right now?
Probably double that.
Wow. Yeah. Holy cow. Yeah. So, yeah, I think you laid things out fairly well. Overall, there is a little higher risk because there's more time. There's a lot of things that can go on during a build, during the entitlement process, or during the lease up or whatever. But the returns are there. So it's a little higher risk, higher reward scenario. And I think in a lot of areas, there's a lot more potential, especially when you look at your cost basis versus buying new. And something else that I'm glad you mentioned that I hadn't realized is ways to de-risk it. You came in after foundation was poured, after it was entitled. So, your investors are probably pretty happy with that scenario because there's a lot less risk and they're still getting upside.
Yeah, that's what's interesting about development. You kind of got to dive in a little bit deeper to see where you can de-risk it, see where you're coming in the deal. If you're coming in before, the developers even purchased the land, or maybe he just got the land under contract, that's probably the most risky position because he's still got to get those government approvals. There's going to be some time involved. He's still got to, hire contractor and all that kind of stuff, depending on if he's partnering with someone or not. There's a lot of factors that go into that, but the further you come into the process, the less risk there is, and the more it starts looking like kind of that ultimate value add type of play.
Absolutely. And one more thing you mentioned that I think de-risks it is you say you're partnering with somebody who's done it before.
Absolutely.
And
that comes into play with anything, even a value add. You want to see people with a track record. They've done it before in the same markets, in the same type of asset, and that de-risks any deal.
All right. Love it. All right. So last question for you, and then we'll start, we'll shift gears a little more, but what's next for you?
Yeah. So, lately I've been using my legal expertise in real estate and securities to partner, well, just not as a service, but to actually partner with a select number of operating groups. Not very many, because I want to work with folks that I like to work with. And, I can only be spread so thin, but basically what I can do is, serve as an in-house counsel role, use my business sense, use my real estate and securities attorney work. And, it's a great alignment of interest. I've gotten a lot of traction with that and had a lot of success with that this year.
All right. So who would be like the ideal person to take advantage of that?
Somebody like you, Brian.
All right. Perfect. Sold. So you come in as a GP member, and then you're also doing all the syndication documents and everything else?
That's right. I come in as a GP member. I'll handle all the legal work, or we can outsource it. It really just depends on what the needs are. But typically, if needed, I'll come in, I'll do the real estate work, I'll do the securities work. I'll act in a role as in-house counsel, meaning I'm part of the ownership group.
Yeah.
Right. And I'm not this third-party vendor that's got 15 million deals that he's dealing with. And you say, hey, we got to turn this PSA. And, he gets back to you a week later. I'm in the deal. I'm part of the ownership group.
Yeah.
I'm in the same boat as you. Our interests are aligned, and we're going to get the deal done.
Yeah.
And it's a little bit different as well, because I'm not only on the legal side, but the business side. So I'm looking at it from that perspective. And again, we're swimming in the same boat, or rowing the same way in the same boat, and trying to get this deal done.
Yeah. I have said before that the perfect people to have on your team as partners would be an attorney and a CPA, as far as, if you're looking for other syndication partners, and partially because and maybe I say that because that's been on my weak point, and my partner's weak points, was legal and CPA, but I love the idea. And, hopefully you get a lot of good deals come from that. So,
yeah.
That said, let's shift gears and bring Stefan on. So Stefan, welcome.
Yeah, thanks, Brian.
Yeah.
Yes. So to introduce myself, I guess. So I am a financial engineer, actually, my prior career. So I've been, I came to the States like at 22. So I came for my master's in New York City, and I've been working in finance for like about 10 years. And in the recent few years, I've been in the real estate industry as a full-time investor, and I actually consider myself an experienced residential investor, because I've done kind of like a few millions of dollars of deals. It's just not where the aspiration is, getting into commercial multifamily, and that's kind of what I've been doing at the moment. So kind of bidding on like bigger, like I guess 50 to 100 unit commercial properties in the Midwest. But my prior career, a financial engineer, I also run a company called Realty Quant, which is an analytics, like data analytics company in the real estate industry. And I speak on data-driven real estate investing, which is basically the practice of like writing lots of code, and essentially like to discover like better properties on the residential, on the commercial side, and kind of modeling properties and so forth. And also at Realty Quant, we are publishing, as you, Brian, know, some market data, some market analytics for predicting predominant downside risk. So that is that. But as far as my experience in the investing space, so like I mentioned, I've done a few different strategies like condominium conversions in the New York City area, in places like downtown Jersey City, Weehawken, and that. I've done like a few other like kind of like arbitrage, like liquidity strategies for like even like smaller size deals as well. So overall, like pretty good experience in the residential space, but I've been always on the verge of like jumping into commercial, and I'm very happy to be here with Seth today to hear about the mindset of that. And since that's pretty much where I am right now, transitioning into commercial.
Yeah, and so I'll just mention, the Realty Quant, that's something that I'm one of his customers. I get his data sent to me so I can know what's going on. But let me ask you a question. What markets are you really hot on right now, since you're doing this data-driven approach?
Yeah, I mean, this is a really interesting question now, especially with the, I guess, like yield curve you guys heard about last week. It's like quite an consideration. And Deutsche Bank came in today with like some of their like recession timing predictions and so forth. And we've seen like mortgage rates rise about 5% yesterday. So it's been like quite interesting in that sense. But I mean, as Brian, you have seen like some of my data on the downside risk. So there I'm seeing like higher market valuations in Western markets predominantly, and then like to a lesser extent in Southern markets, or to some extent in Southern markets. So it just becomes a question of like risk tolerance. My only risk tolerance, being very risk averse at the moment, is in the Midwest.
Yeah. And incidentally, like you said, the data set is somewhat aimed at trying to predict which markets are overvalued. And by that way, you're limiting your downside risk, so if there is another crash or another recession, you're going to be in an area that doesn't have any sort of bubble is the idea behind it. So anyway, I'll put a link to your website in the show notes for anybody who's interested in that. But moving on, one question I do like to ask everybody is what is your big burning why?
So my big burning why, I like investments, and I like doing like new strategies that nobody thought of. And I like doing like analytics. I like doing, so my big burning why is to set points, so to have freedom and also do work that is kind of at the edge of my abilities, kind of like that is stretching my abilities, that I'm able to, like mental exercise and it's kind of like physical exercise, like stay healthy and so forth. So this is really, but combined with the freedom. So to Seth's point, very much, it's very driving for me as well. Like I couldn't do it for an employer. So it always has to be like your own thing.
Yeah. It's amazing how much more energy I have to work for myself than, for somebody else. But all right. Well, hey, thanks for sharing all of that. And that said, Stefan, we got Seth on the line. What do you want to ask him?
Yeah, I think it's a great time. So at the moment, like Seth, I know you mentioned Kansas City, and that's actually like one of my risk tolerance markets, right? Which is great. But what are your, what are like some of the things you're doing differently now in terms of underwriting? Is there different underwriting that you do at the current time compared to, let's say 2 years ago or 3 years ago, let's say, that you have at the moment, or are you perhaps bullish? Because there's like pretty different sentiment on this, I feel, at the current time.
Yeah, I mean, I'm still very bullish on multifamily and commercial real estate in general. As far as underwriting is concerned, so we always talk about what's the most important thing, the sponsor, the market of the deal. Typically, we're going to say it's the sponsor, right? But that's a little bit different than what's the biggest risk to the deal. The biggest risk to the deal is the debt. And that's the part that's a little bit uncertain nowadays, and you need to be careful with. So when you go to your underwriting and you're planning on refinancing in year 2 or 3 or even 5, or you're going to sell, you've got to make sure that you factor in the possibility that those interest rates might be much, much higher than they are today.
Yeah.
And that makes a huge difference in your projected returns in your underwriting. So that's something definitely to pay attention to.
Yeah. Speaking of, I saw a deal come across my desk earlier. Actually, it was last year. I forget. We're only April this year, but about a year ago, and digging through the numbers, they were projecting a refinance after the first year, and they were going to return all of the investors' capital. 100% of the investors' capital, and maybe a little bit more. So their debt service was going to go up by $1.5 million, or that their debt was going to go up by $1.5 million. But with how they baked in the interest rates, their debt service was going to go down. So it's just one of those things where they were assuming like a 3.25% interest rate, and I think you hit the nail on the head, Seth, because that particular deal right there hinged on a very successful year refinance. And we're about a year into that deal, and rates are in the 4s, and for Fannie Freddie, you're looking at mid 4s right now instead of low 3s. So huge deal, a lot of uncertainty there.
Yeah. I mean, when the cap rates are coming down, the interest rates are going up, that difference is getting much thinner. So the meat on the bone is a lot less. So you got to be a lot more careful with your projections and make sure that they are conservative.
Yeah. All right, Steph, you got a follow-on questions, more questions?
Yeah. I mean, what do you think are some of the risks in the commercial space, as far as like you mentioned, because people have been talking about cap rate compression for a long time, but it's really, I always felt it's kind of not the correct narrative, having actually the spread versus interest rates being pretty high at some times. And so, but it's a very different scenario now, because it's like you mentioned, we have like interest rates up and cap rates down. So that's kind of the scenario where, do you feel that operationally it may get harder to execute some deals, like where your cash on cash return is no longer there? and just purely like kind of pushing a project together, pushing a project forward and like pulling like all pieces together.
Yeah, it is. I mean, the operations are going to come into play a lot more than they have in the past. I mean, if you bought multifamily between, let's say 2011 and now, everything, the market would have saved you, right? Everybody's done well, because even if you didn't do a very good job at operating, the prices went up, the cap rates have went down, and you're doing just fine. Even if you didn't do a great job, all these folks are getting into it with their first deal, and they've done, it looks like they've done a great job on paper, but really they've probably made a bunch of mistakes. Those mistakes are going to be highlighted here before too long, because these deals are getting thinner and thinner. I mean, even the deals I see from other people putting out, those projected returns are much lower and lower, and operations, good operators are going to be highlighted and bad operators are going to be highlighted.
Yeah. I think there's a Warren Buffett quote that I love, when the tide goes out, you find out who's swimming without, who's swimming naked, essentially. Right. So, along the same lines, the market has really fueled most of the returns. And as the tide's going out, you have to be able to operate well. And I think personally, it may be a smarter way to invest if you're bringing more capital to the table, instead of going for that 80%, LTV loan or LTC loan, maybe you come in. I think like the core and core plus assets now are going to be a better alternative than your value add or opportunistic. So coming in with 40% down payment on an A or B class asset, that's my own personal opinion, what I'm looking for.
Yeah, agreed. I mean, the better, the class A, the class B, the core plus, even in development, they're looking a lot shinier than your typical class B minus C value add, because the difference in pricing is collapsed so much that it starts making sense to buy something higher quality.
Yeah.
What about actually rent growth? If we have like for more time for another question. So rent growth assumptions that you guys do. I think it's a very interesting question, since on one side, the trend has been like humongous rent growth, but then until when? And so on the other side, it might totally reverse at some point, and assuming we have a recession.
Yeah, I mean, for me, we're still underwriting at, we never really aggressively underwrote rent growth. I mean, even if we're looking at a property in Austin or Charlotte or somewhere where the rent growth has been ridiculous over the last 5 years, we're still underwriting it just the market rent growth, not the forced rent growth at 2%, somewhere that. And then we've actually increased the expenses due to inflation and all that, 3%, 3.5%. So typically we would just do 2% for the expenses and rent growth. But now we're kind of doing it a little bit different, a little bit even more conservative, 2% rent growth and maybe 3.5% expense growth.
Yeah, I think that's smart. I think a lot of people are very bullish on the rent growth, but they forget the other opposite end of that equation, which is, inflation is going to raise your expenses just as quickly or even more quickly than it raises your income. Couple things that I look at, and every property, every market's different, but typically the rent growth lags behind the single family home price growth or the median home price growth. Usually there's a 6 to 12 month lag, and it's about 50%. So if single family homes go up by 10% within the next year, you should get at least 5% rent growth, right? So there's a couple of things on there, and I'm very hesitant to put anything above a 3% on my rent escalator column on my spreadsheet. But I think if there's areas where you have a little more certainty that the rents are going to go up, you can be a little more aggressive year one. But once I get past, once I get year two and beyond, my rent growth is flat back down to 2.5%. So yeah, and the other part of the equation is inflation. We've experienced about 7-8% inflation over the last year, and if people are on 12-year lease or 12-month leases, when their lease comes due, their rents are probably going to grow by about the inflation rate. So, as far as my underwriting, I'm happy being a little more aggressive year one, and that's it.
Yeah, I like that, Brian. I mean, the farther out you get on the timeline, the less certain it becomes. So you can kind of look at where the rent growth has been in that market last year, this year, and kind of project that out for the first year or two. After that, you're really just guessing.
Yep.
Do you have some favorite markets right now, Seth, that you really like besides Kansas City?
I mean, I would love to be in Charlotte and Austin in those markets, but those deals are pretty hard to come by. So you got to go to where the deals are. So right now we're pretty heavy on the Midwest, but the better markets in the Midwest. We just closed a deal in Des Moines. Des Moines is the fastest growing population growth wise in the Midwest. We've been looking there. Kansas City's actually getting a little bit outpriced too. It's hard to find any value add there. Hence why we're doing development, places like that. But always looking, in that Sun Belt. I mean, that's the bread and butter. If you can find anything in the Carolinas, Texas, Florida, Arizona, those are the best markets. It's just trying to find a deal nowadays.
Yeah. And I when I first started, I leaned towards, the Southeast. My wife's from South Carolina and we were living, in the DC area, short drive, so that's where we focused. But I was born and raised in Salt Lake City area, and part of me wishes that I would have gone heavy there because the growth in Salt Lake City has outpaced almost every other market. I mean, Austin's still ahead of it. And, here I am with my University of Utah shirt, drinking from my University of Utah mug. And that's one of the markets that I'm looking at jumping into right now. Maybe 4 years, 5 years too late, but I think there's still a lot of potential in that market. One thing I'm looking at right now, and I want to jump into the numbers a little more deeply. I've been saying this for a month now, but spillover. A lot of people are paying attention to like the Californias and New Yorks, where people are leaving California and Chicago and New York at the rapid rate, and they're going to the Southeast, they're going to Texas, they're going to Phoenix. But the question that I have is, when Phoenix gets overheated and when Salt Lake gets overheated and when Boise gets overheated, where's that spillover gonna happen? So that's what I'm starting to look at right now. I haven't quite answered the question, but I'm thinking that there's going to be some, secondary and tertiary markets that are going to explode in the next couple of years.
Yeah, agreed.
All right. More questions?
I think I asked most of the questions that we covered today.
All right. Sounds good. So, all right. We're about out of time on this one. So I want to thank both of you guys for coming on the show today. Very much appreciate your time. Great conversation. And one last question for each of you. And Seth, you get to go first. How can listeners learn more about you?
Yeah, check out the podcast. Go to passiveincomeattorney.com. We've got some free content there. I'm up to 3 episodes a week at this point. So there's tons of stuff on there. We've got some articles. We've got some free downloads, all kinds of good stuff. Get on the mailing list and jump in my circle. All right. www.passiveincomeattorney.com. And incidentally, we're at 3 a week right now. And, I think I look at these guys who are doing daily shows and just makes me scratch my head. 3 a week. Crazy. 3 weeks enough. So, all right. So that information will be in the show notes, passiveincomeattorney.com. Check out his podcast, check out his website. Stefan, same question for you. How can listeners learn more about you?
Yeah, you mentioned, Brian, earlier, my website is realtyquant.com. So this is the best way. I also run a weekly live webinar called Finance Meets Real Estate. So they can check Finance Meets Real Estate on YouTube as well.
All right. And we'll put links to that Finance Links Real Estate YouTube site in the show notes and realtyquant.com there. So definitely check out what he has to offer. And once again, thank you to both of you for coming on the show today. I very much appreciate your time. Thanks, Brian. Appreciate it. Hey, if you like that episode, make sure you hit that subscribe button. But more importantly, if you haven't joined our multifamily educational community, the Tribe of Titans, yet, you are missing out. So get yourself 30 days free by clicking the link below in the description, or go to thetribeoftitans.info, and we'll see you there.